Welcome everyone. Welcome to this knowledge session of eQualify. This is an initiative of eQualify in collaboration with LSEC, as well Refinitiv. This knowledge session with an endeavor to bring a lot of new trends in wealth management industry and asset management industry across different parts of the globe. And we'll touch upon latest trend across different wealth management format. Also, we'll discuss about some of the relevant trend in Indian perspective. So to give a brief background of LSEC, which is erstwhile Refinitiv, which is the global leader of data and analytics, as well as market infrastructure provider across several decades. Having worked with different market with the different wealth management entities, asset management entities, this brings with a lot of intelligence around its experience from a global market. Today, we have invited Mr. Balakrishnan Ilango, who is a solution practice lead for Asia Pacific. Bala has worked with Refinitiv for almost nearing 2 decades. Prior to that, he has worked with a lot of global IT companies, including Oracle. He would take you through different trend and also give a perspective of some of the data analytics component, which is very relevant today as we speak. Over to you, Bala.
All right, thanks, Alok. Hope you can hear me okay, right?
Yes, you are audible, Bala.
Okay, great. Let me share my screen. Then probably let me start. Yeah, you can see my screen, right? Hello?
Yes.
Okay, perfect. Thank you. Thank you, everyone, for joining the session today. Today, I'll be taking you through the data and analytics-driven, advisory. Just before getting into the topic, I just want to give you the broader perspective on where the industry is heading, and then we'll try to get into the details of the topic, right? And as everyone know, the global wealth management industry, continue to sort of grow. These are all the global numbers, right? You can sort of see both the financial and the non-financial assets or the debt under wealth management has been growing significantly. Globally, the financial assets is significantly higher than the non-financial asset. But we also for Indian perspective, it is other way around. But still, we are significantly sort of growing there. Given the changes, right? In our Indian perspective, starting with demand, UPI, and the total financial inclusion, right? That itself it is significantly contributing towards the growth of the overall wealth management industry itself, right? So given this, there is a huge sort of change which is happening in the overall wealth management industry. The major disruption is happening primarily because of the shifting demographic. That's one. And the second thing is clients are asking for cutting edge sort of client experience, and also the digital technologies are also acting as major catalyst to this sort of disruption, right? So given this, let's look at the overall how the wealth management model sort of evolved. To start with, wealth management was covering predominantly the high net worth and ultra high net worth individuals in the family offices, and then eventually it is moving towards the next gen, meaning the affluent and the mass affluent set of category as well, right? That's a massive change which we could sort of see now. Before we started off with just human only, then with the help of digital support, and mobile banking, that sort of helped as an enabler. Now when you look at it, it's human led for plus digital, and also we have a kind of hybrid set of model there, right? And product wise, before it was more focused on traditional and active assets, meaning active fund management, funds, there. Then we moved on to passive. Now the wealth management industry could sort of see a shift change there, with the direct indexing, having alternates assets into our portfolio, including even digital assets, and also there is a heavy focus on impactful investments as well, which is part of ESG sort of framework, right? And as a services wise, before it was highly tailor-made, portfolios the wealth managers used to sort of make it. Then it came with the distinct models with advisory, execution only, discretionary, plus the high touch sort of services. Now it has become highly modular and personalizable service offering, right? So one of the key thing, what we could, see in the change is inclusive of, the millennials, meaning the mass affluent, sort of a class, which, the wealth management industry was, haven't touched, before, right? So what is in for the global, wealth managers, right? So this is one of the stats, which I wanted to, give you the perspective here. This is something which was published by one of the consultant, Oliver, Wyman. They did a market sizing, and that's a number you can sort of see it. The top chart indicates the growth in asset under management and wealth in terms of $1 trillion. You could sort of see it here across affluent and low HNIs, or HNIs and ultra HNIs, and the bottom chart indicates the total revenue that can be that can be made out of managing these wealth for these set of clients, right? So with this, their expectation is affluent and low HNI segment is about to generate additional $45 billion of new revenue by 2026, right? That amounts to 60% of the total wealth management revenue pool, right? That's sort of quite significant, right? So that is where we could see a massive sort of shift which is taking place, where a lot of global wealth outfits started off servicing the new millennials, predominantly the affluent sort of class there, right? So to unlock the entire, to unlock the market opportunity on this space, right? Further digitization, self-service capabilities, your scalable processes, and the ability to deliver curated and streamlined solutions are, definitely heavily, sort of needed there, right? Again, not all the wealth managers, may get into that space. Some of them may even operate in terms of high net worth and ultra high net worth segment, but we could sort of see a huge trend, especially with some of the large global banks, creating a kind of omni-channel access, right? To in terms of taking care of all these sort of segments, and especially the affluent sort of segments there, right? To give you a perspective, this is the kind of framework or the omni-channel access we could sort of see it in the global marketplace with the wealth managers, right? So this is a kind of new introduction, which is like the personal advisors to take care of the affluent guys with low cost sort of service, right? That is for that some of the wealth managers have been investing on one-on-one video chats or phone-based sort of advisory service to sort of take care of that particular segment. Then again given the digitalization which is getting evolved, as an easy option, right? Robo advisory is definitely there. We are now more than that. There are a lot of self-service investment option for do it yourself kind of platforms have been coming up significantly as well, right? So given all this, right, to attract new client base, and also to build a kind of a level of trust with the clients, right? So we started off with the series to sort of act as a medium to educate how data and analytics can help enabling the wealth managers like you to take a better decision, and also to manage the client money efficiently, right? So with this, I just want to take a pause and give a background here, right? So far when our industry, our wealth management industry is heavily focused on funds, then come direct equity investments, your direct fixed income investments, and so on and so forth, and alternates and so on and so forth, right? Let's take an example of funds. So far when you look at it, the advisors or market participants have been heavily focusing on NAV level performance analytics, right? So you may look at returns, you may look at risk adjusted returns in terms of all different stats, and again heavily calculating all these stats out of just NAV level, right? So one of the key change we could sort of see in the marketplace is like people, or some of the global wealth managers started getting into the nuts and bolts of it, in terms of getting into or building everything in terms of bottom up analytics, right? That's where we help some of our global wealth managers significantly out there, right? To just give an example, there are so many funds. Say, for example, when you take any specific category, like let's take an example of large cap or mid cap, right? There are 40 different funds out there, right? Before investing, right? You may need to assess the fund manager sort of skill. That's what the performance attribution sort of helps, right? Performance attribution is nothing but the fund performance, right, under the microscope to assess the fund manager skills, right? That's the the attribution is all about, right? So for that, what we have done, for the community is, we take the entire, portfolio on month basis, the way the funds have been, giving it to us, and we loaded all of that into a kind of, portfolio warehouse, right? So for example, if you want to assess on any specific name, all you need to do is, just, select that particular name, and then it runs the entire analytics, taking into all the stocks, what it is made or available out there month on month basis. It runs the entire analytics for you, right? So for instance, just before getting into the analytics itself, just want to give you the basic background of it. The first thing is always one has to look at is what is the kind of portfolio allocation which that particular fund manager has done it, right? One, it could be allocation across different sectors, or within the sector there could be industry, or we could sort of look at stock level itself, right? That's one. And two, comparing that with benchmarks. Say for example, if it is a large cap fund, it could be Nifty 50 or CNX 100, or if it is like in the mid cap, there could be mid cap as a benchmark index, always one would compare with, right? First important thing, foremost thing is to look at what is the kind of active weight, right? So meaning is that specific fund manager heavily overweight on any specific sector, or significantly getting underweight on any specific sector, right? That's one of the key important feature to sort of look at it, right? The second thing is the returns, right? So you have the portfolio returns, and the benchmark return, and the difference, what we call it as active return, or you can call it as alpha itself, right? So there are analytics one can run. Predominantly Brinson is what predominantly it is used, and there is multiple flavors of Brinson is out there, right? Which helps to dissect the active return into sector allocation and stock selection. For example, if a fund manager has created an alpha or active return of 10%, right? This will help us. The analytics will help us to break that down, right? Say for example, how much of the percentage has come from stock selection, sector allocation, and how much it has come in terms of stock selection, right? This is very, very important to assess the skill of the fund manager, right? Or before investing in any of the funds, right? For a large cap, sector allocation is the key to beat the benchmark, and especially for mid cap and small cap, the skill of stock selection is imperative to beat the benchmark consistently, right? So given this, right, I've taken one of the mid cap sort of fund. So on the fly, right, when I select the fund, we run the entire analytics, right? One can sort of see what is a kind of allocation he has done across different sector, and also the different names which the the portfolio manager is holding on his portfolio, right? What is important to look at is, comparing that with the mid-cap benchmark, right? To see where the fund manager is going overweight or underweight on, right? So you can see here materials, the fund manager has 25% exposure, and you can see the benchmark exposure is less, and the difference is 14%, right? Then you can see financials is where he is significantly underweight on financials, right? So this sort of helps again to understand what is what is a kind of fund manager is doing it as a kind of strategy. The next comes the complete attribution, right? So now let's look at it. For this particular fund, I've taken 1 year from yesterday. So the top line is what you can see it as a fund performance. So it has generated a return of 7.7%, and you can see the benchmark return as 7%, and that translates to an active return or alpha as 0.7, right? So the model helps, the attribution helps in terms of dissecting that 0.7 into how much of return, right? Say for example 5.5% out of that 0.7 has been generated out of allocation, and 0.2 the fund manager has created out of stock selection, right? And one can drill down to further set within that sector, or within that company, within that particular sector, which companies are where he did very well in terms of stock selection and so on and so forth, right? Say for example, the strategy of the client, of the fund manager in terms of going overweight on materials, help them in terms of creating extra return compared to the benchmark. Probably the other way around, right? Where he went underweight on financials, that sort of eroded his performance by a couple of percentage there, right? So this again sort of help to understand the entire dynamics. And again, even when you are on conference calls with the wealth managers, with the asset managers, you can always this will help you to ask right set of questions, right? What worked well, what didn't work well. If you want to get some more details from the fund managers, it would sort of help significantly there, right? Okay, so we have seen the selection skill for mid cap fund or small cap fund is very, very important, right? At the same time, right, how do I assess, right? Should I be looking at just 1 year, 2 years, 3 years, or 5 years sort of performance, right? So instead of just point to point for performance 1 year, 3 years, and 5 years, it's better to always look at kind of calendar year performance, right? Again, not naming a specific fund manager. We've taken an example of one of the fund manager. So you can see the alpha over a period of time going back from 2017 to 2022. So you can see consistently the fund manager is able to sort of create alpha, and he's able to consistently create it because he's able to his stock selection skill has been absolutely great, right? So this significantly helps to identify the best the fund managers or the funds out there. Another thing is building trust with our clients, right? With your clients. So when you take this level of analytics to your clients to demonstrate, oh, this is a kind of strategy we adopt in terms of identifying some of the the funds to have it within our portfolio, that would add significant value. That is what we could sort of see it with our clients out there, right? Especially for when you're managing portfolios of 20 lakhs or 50 lakhs, it's still okay. But the moment when you are managing a large money, right? Say for example, like 5 or 10 or 50 crores, then definitely the client would be more informed with out there. But any analytics or any insights when you try to get them in terms of your process, right? That would add lot of or that has added a lot of trust with our clients, right? So, but again, we don't limit just with bottom up in terms of looking at all the different analytics. The other thing what we do is since ours is a multi-asset sort of platform, we do whole host of different analytics at stock and fixed income, meaning at the bond level as well, right? Just want to give you a flavor to you, right? So one, when we talk about a single company, right? We have two set of quantitative models we've sort of built in. One looks at the credit risk, another one looks at the kind of alpha models, right? So say for example, if you want to some of the fund managers also leverage these in terms of identifying or generating they use these models to generate ideas, to look at all those names where the ranking, meaning the scores of all these the different models, whatever we put it out there, it's all in a scale of percent, it's a percentile score in a scale of 1 to 100, 100 being the best, right? Say for example, when you look at this particular fund, when we look at materials, within materials, quite a lot of names, right? He had quality names and all credible names, right? Barring 2 or 3 names, where in the recent past, where the credit where they have built up huge debt, because of that, the credit scores have significantly come down. But rest of it, the fund manager has invested in some of the quality names, right? Likewise, one can sort of look at it at a portfolio level. What is the kind of earnings quality at a portfolio level or fund level, or across different names the fund manager sort of invested in, right? So here in this given the market scenario of massive credit risk which is happening, we want to just focus on that, and we want to just leave one sort of use case out there, right? How we are helping our wealth managers like you in terms of identifying the weeds, right? Before any major issue is going to come in, right? It could be with direct investments on any of the names, or indirect investments within the funds as well, right? So we sort of solve both the problems out there, right? So given this, I want to give an example of identifying early stress with our analytics, right? With an example of Credit Suisse, right? So you can see you can see a chart here. We've taken it from 2020 to early 2022 to September 22, right? Credit Suisse story has been out there in the market since last year, right? 3 lines you can sort of see it. The blue line represents our Starmine credit risk model, where we provide the probability of default score, right? Based on a revised sort of Merton model. And the red line, what you could see it is the CDS spread, and the green line, what you see is the benchmark spread, right? These 3 acts as a significant indicator, not just limited with these 3. Even the credit rating agencies out there, right? They also add significant value in the system, right? So here, with our data, right, with the data or analytics, right, we add significant value, especially for Indian names, right? There are not many CDS spread which is available, specifically Starmine and benchmark spread add significant value there. Again, with benchmark spread, there are a lot of liquid, illiquid names out there, right? We do price it up, working with the market participants, and then we calculate the we compare that with the benchmark yield, and then we sort of provide the the benchmarks spreads out there, right? So given this example, you could sort of see it before the actual issue which was came in September, right? We could sort of identify some of these kind of stress, right? 6 to 7 months ahead of it, right? So before the probability of default score used to be like 0.5. Last February, towards the end of February, it spiked to like 1%, and so do you can see the CDS and the benchmark spread spiked and doubled, right? And then you could sort of see series of credit rating agencies revising their rating significantly sort of downside there, right? That acts as a sort of catalyst. So we provide all this analytics. Say for example, simply if you upload your holdings into the system, right, it runs the entire analytics and gives you what action you should sort of take it, right? That's one. For any of the fund holdings, right, and since we have the entire holdings out there, say for example, there has been a lot of post this Credit Suisse and SVB fiasco, the AT1 bonds, even in India, it sort of with the benchmark spread sort of spiked, right? For you to look at all those indirect holdings with any of those funds, and if you want to revisit investment in terms of funds, right, it sort of adds significant value out there, right? So far we have seen all one, we looked at assessing, the fund, and also, we looked at, the holding level analytics, within those, sort of, funds, there to take a decision in terms of whether to invest or hold, or sort of, take any decisions on those, funds, right? So next, we're trying to move in terms of, portfolio analytics with, with the true multi-asset portfolio analytics, what kind of insights, you can sort of, derive, with the platforms, right? So all you need to do is like, simply if you, create a portfolio, right? With whatever, the holdings, it could be fund, it could be a combination of, fund, equity, fixed income, or even, alternates, right? We can sort of, handle within our platforms. Especially for alternates, the industry hasn't completely evolved, and there is no regulation, for them to, disclose the NAV, periodically. Only as an investor or a wealth manager, you may, with that investments, you sort of, directly get it, right? We've created a platform, where you can push all this, custom data into the system itself, so that the system can, do the entire, heavy lifting or run the analytics, for you, right? So here, what I've done is, we've taken few, fund investments, right? So one, it runs, it provides different analytics in different dimensions, which I want to sort of, give you what level of insights you can derive, out of these kind of, analytics, there, right? So one, it gives overall, say, between equity and fixed income, right? We have 75%, we have exposure with equity funds, and roughly 24 to 25%, we have it, with fixed income. And again, within those, right, what, the category of, funds which we have invested, you could sort of, see that here, right? So you could see a little small arrow mark, with every fund, right? This is something like, when you click on it, you will be able to, see the entire look through, meaning all the names, which Axis or DSP midcap, sort of, holds, and you will be able to see how much that is rolling up to, sort of, 14.5%, right? That's the level of, look through we sort of, provided. So here, the major thing to look at is a kind of, contribution analysis, right? First, right? Say, for example, with the investments, whatever we made, say, I ran an analytics, for last 1 year, right? You can see, overall portfolio has generated, 5.4%, right? Between equity and, fixed income, right? It is very close, right? Roughly around, 5.4 and 5.5 is what, we got it from equity and, fixed income respectively. Within that, right, the contribution analytics, helps you to understand where that particular return has come from. Say, for example, when you look at it, FlexiCap, did, decently well, right? Probably 9.4% out of, 5% has come from, FlexiCap, right? So what eroded, in terms of, the numbers is, the allocation towards, one of the thematic or focused, sort of, schemes. So that's where it has eroded, sort of 7.9%, there. The rest, we did decently well. Even midcap, contributed. Midcap, since we had a significant exposure towards, midcap, right? Even that sort of, contributed, there, right? So definitely all the fixed income funds also, sort of, significantly contributed, given the market scenario, there in the last 1 year, right? Next is, portfolio statistics, right? One, you would have seen the portfolio statistics at, one calculated at an NAV level. This is again, doing an entire, bottom-up approach, to look at it, right? Some of the key ones, right? Batting average or maximum drawdowns. Now, what is the kind of, realized, tracking error, which I have, right? Which compared to the benchmarks or upside, downside captures ratios, standard deviation, meaning volatility. So the entire risk-adjusted statistics, you will be able to sort of, see that. And again, you can compare over a period of time, 1 month, 3 months, 6 months, or year to date, or 12 months, you will be able to do a complete, deeper, sort of, analytics out there, right? Not just limited to this, especially in terms of risk, right? This is something, which we have seen not many, wealth advisors are doing it, or, we whenever we speak to, our clients, they thrive to, do all this, right? So which is like, knowing your downside risk of the client portfolios, right? So taking into consideration of, our investments, across all these funds, right? What if any of these historical scenarios, right? Say, for example, Black Monday or COVID or fall of, 2008 or Brexit, if it is going to happen in the future, what is a maximum loss I can lose at 99% confidence level on a single day, right? That's what you could sort of see it here, right? Say for example with Black Monday or COVID-19, if it is going to repeat, right? That's where I could sort of see that as significant negative return I could sort of make it, right? So one, when you look at can this alone be helpful, right? When I'm looking at at a portfolio level, it may not, right? So for me to make a better decision, I need to dissect across all my holdings of investments. Only then I can see where it is contributing significantly more, so that if any of these events, if I'm hearing or if I'm forecasting to sort of happen, then I know which ones to sort of exit, or which positions which I need to sort of trim on, right? So that's where it comes here. So you can see across all of these, right? Be it Black Monday or Asian crisis or Brexit, not at a portfolio level, you can see at the allocation level between equity and fixed income, or even at a scheme level or specific instrument level, you will be able to see all those sort of numbers there, right? So given 7% impact on Black Monday, right? So 3%, roughly 3% out of 7%, I may get impacted with my exposure towards mid cap, right? So if anything is going to happen now, I know which ones I need to sort of trim on, right? Having said that, right, given any of these scenarios, definitely the fixed income performed decently well, or the risk of losing money is significantly low. So I know when or where I should sort of allocate my money on, right? But again, it's not limited with just the historical scenarios, right? This is where the predictive stress test comes into play, right? What if I want to check with different scenarios, right? Say for example, right, interest rates going up or down by 50 basis point or 100 basis point, right? Or like global world index going down by 10%, or crude going up by 50% or down by 50%, right? Or just Sensex going down by 10%, right? So one, if Sensex as a local market, if it is going to go down by 10%, this is the portfolio impact I may have sort of have it. So 5.9% I may sort of lose compared to the benchmark. I may be better off with benchmark comparatively as a relative sort of return. Again, this again helps to make a sort of wise decision. At the same time, it's not about a single scenario. Even I could one can do a combination of scenarios, right? Say what if Sensex going to go down by 10%, at the same time interest rate going up by say whatever X basis point, at the same time crude or gold going to go up by whatever 10%, right? So you can do a kind of combination of scenarios. We call it as the custom algos, which you sort of you can run it to understand the kind of downside which you may sort of look at it, right? And again, like the way we have seen it, not at a portfolio level, all the entire analytics, you can run it at the holding level as well. Let's have a look at, say for example, with Sensex go down by 10%, right? I can go and look at what is the kind of impact I may have it with Flexi or large cap or mid cap or small cap kind of funds exposure, so that I know. And again, I can always compare that with a relative basis, and then take a sort of better decision out of that, right? So let's move on. And again, it's not just limited with that, right? Now, other thing is always one of the key things which we as a wealth manager we look at is I might have taken an X amount of risk, right? For that X amount of risk, right, you should get that Y amount of return, right? To have the risk reward better, right? In a way, if you want to see all those sector level or broader category level, or even at investment at fund level, right? If you want to sort of see it, right? VAR or IVAR, incremental VAR helps to quantify the risk. So you can sort of see here, right? So one of the couple of names with mid caps, we've seen it, that's one of the things which we're sitting up with slightly on the higher risk in our portfolio. You can see how much of written it as sort of generated, right? Say for example, if it is other way around, if I'm seeing somewhere here, right, if for the kind of risk which I've taken it, right, if I'm not getting compensated in terms of returns, right, that's where it sort of gives you an idea, right? Either you want to trim it or exit some of those funds out there, right? Say for example, one of the thematic fund, they're slightly at a lower risk, comparatively, right? Given my smaller exposure, which I have it, with that particular fund, but again, it has, generated significantly negative return. Sort of, helps me to identify, those names to sort of, rebalance it, right? Okay, so far, what you've seen it is at a, fund and a holding level. The other set of insights always it helps us to do a kind of look through within the the portfolio. Say for example, we had fixed income funds and we had equity funds, right? If I want to aggregate all the equity positions, and if I want to see the equity characteristics out there holistically, right, this is the picture you would sort of get it. So one, if I want to see, this is the kind of indirect allocation, which you have it with exposure, towards the equity funds, right? So we are heavily focused, or invested on, financials, which is, 24%. And the least is real estate, which has an exposure of, 1.3%, right? At the same time, if I want to look at, some of the key metrics like, what is the trailing 12 months, P ratios 25, forward P ratios, better off, it's, trading at 20 with the dividend yield of, with the implied dividend yield of, one roughly around, 1.08%. And, the growth rate of, 18%, which is giving me a lot of, better conviction in terms of, overall, portfolio. And also you can see the characteristics, right? So we have heavily, we have been more focused on, slightly, larger cap, sort of, names out there, over there, right? Again, fixed income also, it is very important to look at, say, for example, aggregating all the fixed income names, by looking through the next level of investments, which the fund, carries it. The overall duration of, my fund is like 1.8 with a yield of, 7.4% with a convexity of, 0.08%, which gives me, a lot more, sort of, comfort. And also, one can look at the fixed income, issue level and issue level sort of exposures, right? So say for example, issue level, right? We have, heavily investments on, government, bonds. Next come, rest of these, set of, names. And also, we do a lot of, massive heavy lifting in terms of analytics, right? Especially, when you look at, fixed, you just imagine if you have just a fixed income portfolio, and if you want to look at all the cash flow projections, right, for next 12 months, both in terms of interest amount, accrued interest, and the capital amount, right? We can run, and you will be able to see all the future cash flow at a portfolio level as well, right? Not just limited to this, right? One of the key asks from the market was to look at the group level exposures at the ultimate parent level, right? That's another problem which we sort of solved it. Again, fund by fund, it the system takes the entire bottom up exposures, and then and we have the entire entity level hierarchy as part of the system within the data model, and then helps to run that level of analytics there, right? Say for example, anything with more than 5%, I've flagged it to sort of review it. So this is with government bonds, which I'm still okay. But say, for example, if I want to look at like ICICI Bank, meaning ICICI Group as an exposure, right? I could sort of see, or I can dissect, what is my equity exposures or fixed income exposures with ICICI, right? So I have two major names, ICICI Bank and ICICI Pru Life Insurance. That's where two indirect exposures and sort of carry it. And these are all the different fixed income names I have exposure with, right? So likewise, if you want to look at overall, Adani's exposure, Axis Bank exposures, or any or Reliance's exposure, right? One can sort of see it holistically out there, right? The other thing is, when you are monitoring portfolios, right? Especially the equity fund portfolios, right? When you sort of carry it. One of the key ask, what we've seen it with some of the portfolio manage, some of the wealth managers is they always want to understand the sensitivity of the portfolio to a specific sector or anything specific there, right? Say for example, this is where we have our multi-factor global equity multi-factor set of models, right? On the fly, it will run by taking into consideration of all those underlying exposures that particular fund has in terms of equities, and then runs all the different sensitivities, right? I want to the forward-looking risk, right? Meaning we call it as ex ante risk, right? Which is like 14%. And the active risk, compared to, when I adjust with, when I compare that with, benchmark, the active risk contribution is, 5.5%, right? Compared to the benchmark, if, my, portfolio is heavily exposed or highly sensitive towards, energy as a sector, and I can always, see some of the few names as well, right? Say, for example, if anything with crude or anything with energy as a segment, or the sector, if there is any specific impact, right? My portfolio may be sensitive, towards that. So understanding those, always, helps. So anything, if it is, happening out there, you always, know what kind of, action you need to sort of, take it, right? So these are all the stuff, which we want to, cover on, the data and analytics, side of it. Just wanted to give, the thoughts, how we are solving the entire, the challenges of, the wealth managers with across, different, workflows. I just wanted to give, the thoughts on it, right? We help, starting from, client acquisition, meaning opening of, accounts to, getting started or generating ideas or doing a, portfolio of strategic asset allocation or doing a tactical asset allocation or placing a trade, to managing the portfolio and monitoring the portfolios. And again, we again, help in terms of, these are all the different, sort of, your investor journey, right? We pretty much, help, everywhere to just, resonate, better. These are all the different, challenges, typically we have seen it, with our, clients. Say, for example, how can I onboard, some of my clients, quickly, right? This is where, we have our, risk propositions, which helps, identifying or doing the complete quick KYC and, onboarding, the customers, quickly out there. And we have been helping, a lot of, wealth managers like you, even in India. Also getting started, get the clients, committed, trade efficiently, keep them informed and keep them, engaged. And these are all the different, stack, which we sort of, carry it across, right? Starting from creating interest, onboarding, some your clients, quickly onto the platforms, and creating the level of commitment, with the analytics and the digital platforms and the analytics, right? That sort of significantly helps. And also, with a lot of portfolio analytics, right? The system can help you generating a lot of analytical reports to help your clients and also you to stay informed in terms of what's happening on overall markets, or to understand some of the the risk which may be coming in. And also we have some of those different platforms and tools to keep your clients engaged as well. Yeah. So that's pretty much it with the presentation. So probably we'll be happy to take some Q&A.
Yeah, thank you, Bala. There are a few questions in the chat box. For the interest of time, let me pick a couple of relevant one. So Arvind has asked, we are considering benchmark return for the comparison when evaluation. So what about peer comparison?
Absolutely. Okay. So this is the that's a great question. Probably I missed to cover it. Say for example, if you want to compare a particular fund with another particular fund, yes, of course, right? Instead of benchmark, all that you need to do is just select that specific fund and you will be able to see the comparison between two asset managers. Say, for example, if I want to compare A with B fund manager, say, for example, we have seen it with materials, he is, significantly overweight on, probably another fund manager might have, significantly overweight, or might have gone overweighted on, significantly on technology, right? Where that returns has come from, right? Absolutely great. One can run great analytics, comparing across, names. Right.
Thank you. There are other questions. These are rather subjective. Gautam has asked, how do you compare your platform with Morningstar? I'm sure you don't want to compare in direct way, but if you would like to give a broader overview, what Refinitiv, Workspace, or Desktop as a platform cover?
Yeah, absolutely. See, ours is a multi-asset, sort of platform. We it's not just limited, with funds. As I said, right, we solve multiple different challenges, for our clients out there. Now, given the wealth outfit, say, for example, you've seen the credit risk use case, which I took it as an example, right? That is something very unique, which we've sort of built it, and that is something which we have been helping not just the wealth managers, even the large asset managers and pension funds, we have been helping out there, right? So we add a lot of value, and we have shown probably, and I would say, I should admit, we might given the shorter time frame, right? We've covered probably 10 to 15% of it, right? It has a lot of different capabilities out there. It can sort of help. So as a knowledge series, right, we have also planned to educate you more with the next set of insights or analytics which we want to share.
Thank you, Bala. For the interest of time, we are almost toward the end of the session. We'll wait for a couple of minutes if somebody has any question. I don't know whether they have an option to speak out. Anyway, we'll wait for a couple of minutes. Meanwhile, once we get some question, I would like to give an overview. So as a solutions, Refinitiv cover both digital solutions as well as desktop solutions. As this is a series, knowledge series, is one of the workshop or one of the knowledge series where we have picked up wealth management as a data analytics point of view. Would be, if you are interested, you can show your interest to equalify. Would be happy to organize in-person workshop or maybe this knowledge series going forward. For any further query related to the presentation Bala has presented today, you can reach out to me for any solutions from Refinitiv LSEC. My details are given below. We'll hold for one more minute so that if you wish to note down, you can do that. Okay, thank you so much. Thank you, Bala, for taking out your time. And thank you, everyone, for taking out your time at the middle of the week. And many thanks to Aditya and entire Equalified team to taking this initiative of knowledge series. As we all know, India is at the cusp of to become one of the pioneer or front runner in case of wealth tech, as well as it has showcased in payment as well as credit tech. Would be happy to partner with the industry and do a lot of knowledge sessions going forward. Thank you so much, everyone, for attending this session. Thank you.
Thank you very much, everyone. Thank you.